And welcome to Moving Market Podcast monthly recap. David, looking back to March, obviously a lot of events going on with the Iran war, a lot of changes within the market we've observed, worst month in, long term for the markets. So let's recap and look ahead to, what to expect April and beyond.
Yeah, Joe, I think kind of as you pointed out, March definitely a difficult month for the markets, and we will walk through some of the just different markets and parts that were impacted. But as you look at the overall quarter, not as bad as fear, I think, even with the drop in March. But as you look at it, the S&P was down about 5.5% for the month, and that brings it to about 4.5% of the year. So slightly positive heading into March, and obviously reversed all of those gains. But as you look at other areas of the market, for example, international was the worst performer in March. And again, because you saw some of the trends that we've talked about start to reverse with the US dollar. We'll get into that in a little more detail, but you saw emerging markets and developed markets down between 8 and 9%, but still positive on the year. You had the Nasdaq down 5% in the month. Mid cap and small cap were also down about 5% in the month, but still positive for the year. So you saw a big, again, a big move in every index. And the one area that's continued to perform well, relatively speaking, is equity income. Equity income, is up 5% for the year, despite the sell-off of, 5% in March. So as you look at every index, again, down 5%, with the exception of a handful that were down slightly more. And you did see bond yields increase as well. So typically, when you see a uncertainty in the market, a war start, or any kind of a shock, you typically see bond yields go lower. But in this case, bonds also sold off, and really the only place, that investors sought, I guess, to hide out was in cash.
Well, and you look, David, so to the point, if you look at the markets the last 5, 6, 7 months, you've generally been in a weaker dollar, inflation looking like it's easing and interest rates looking like they were going to come down, right? And that's kind of where a lot of the trading pattern within the markets had been until March. Now, during the month of March, you saw the dollar appreciate about 4%, which isn't a lot, except, in a few weeks, it's a huge move. And it's just had repercussions, throughout the market overall. As you mentioned, international stocks led the way down, right? Overall. And as you look ahead, how long will inflation be elevated, right? Is it going to be more of an energy jump, or is it going to kind of go across the board? And the other challenge you have heading into March was the economy slowing down a little bit. So you're really going to be stuck now with the Fed between inflation, which Powell acknowledged last week that he's not likely to raise interest rates, which the market had been concerned about. They're looking more of inflation being a short-term spike, but not a long-term concern overall. We'll see how that plays out. But the bigger concern from my perspective is, will consumers slow down? Will there be, an overall economic slowdown, which will be the challenge, to bring interest rates lower potentially to help the overall economy. And then when you look at the labor market, you had jobs data out better than expected. On the other hand, as you review, last few months, what do you see, David?
Well, I mean, as you can see, right, it's just whipsaws. You have positive months and negative months, and really, typically in a healthy economy, you're creating somewhere between 150,000 to 200, maybe 250,000 jobs. That's kind of in the normal range. We've seen a total of 84,000 jobs created over the last 6 months. So again, going back to October of last year, and as you can see, pretty strong down month. Some jobs created, a little bit of job loss, more jobs created in December, job losses in February, jobs created in March. So you're seeing it's pretty uneven. And even as you go back further, all the way back to June, you've kind of seen this whipsaw. And so what you're coming to is, maybe about 15, maybe 20,000 jobs a month on average, which really is just showing a weak labor market. That being said, you're really not seeing a lot of job cuts out there as well. You've seen the last 2 months of job cuts, announced by companies, be at, lows essentially. So it seems like a lot of the AI and efficiency gains, at least as part of the first round, have been done. And you're seeing companies kind of adjusting, especially also after labor, grew significantly after COVID. And, if you look at ADP, they also put out an employment report, And what it's basically showing is it's definitely showing a more robust job market. You're seeing more job growth. Obviously, if you look back to last year, there's significantly more jobs that have been added. So this could be a shift potentially, to more people being self-employed, more of a move to the gig economy. And what we've really seen is a lot of this growth has come from jobs or companies where there's, 1 to 19 employees. I think, many of those are single person companies potentially as well. And so there's some noise in the data, but the labor market doesn't look, overly strong or weak. It's just kind of, you know, slow.
Well, and you look at the impact of interest rates, David. I mean, housing looked like it was going to pick up this year as mortgage rates fell to start the year. Well, mortgage applications were down dramatically over the last couple of weeks. Obviously, the uncertainty of the market decline and interest rates up, housing market short-term freeze, in a lot of ways. So we'll see how this plays out, into the summer and beyond if mortgage rates start to move down and kind of if people are starting to feel a little bit better. And when you look at the impact of 4 or 5 weeks of the market declines with the war going on, we'll see where things play out. Is there a ceasefire on the horizon? What are the details and where do investors go? And even before this, like I said, there are a couple of concerns overall within the markets. You had private credit, which continues to be, somewhat of a concern where you have a lot of, you know, individual loans that are part of funds that are illiquid have halted redemptions. So investors can't get their money out all at once. So it's slow, and on top of it, you've seen credit being cut to those areas. So we'll see, it's definitely some area to monitor. The way we reacted is reduce, financial exposure in the short run to some of these areas. And again, a lot of this to me goes all the way back to the financial crisis, where anytime you have some concern about lending or the financial system, you kind of sell all the financials, whether it's a real concern or not. It's a short-term reaction, I think, within the markets. So we'll see what earnings look like in that area overall. And you still have the tariff overhang, right? And where that'll play out overall. But again, as you turn to some of the positives, tax refunds are higher. Maybe the short-term pessimist says that it's going to go into higher oil prices in the short run, which, there's some truth there. On the other hand, you look at activity in the economy. Economy's still holding up relatively well. The IPO markets, you could have some of the largest IPOs ever to hit the markets this summer and beyond. So there's still, decent amount of positive activity overall. And then when we look at, some of the other stuff to review, David, you look at, maybe some of the commodity, oil price shock. We look at gold, and then, maybe we could talk about what the Fed's likely to do going forward.
Yeah, Jared. Well, I think as you kind of mentioned earlier, you've really seen the dollar move, right? And so, initially, I guess really over the course of the last year, you've seen a trend of the dollar, getting weaker, right? And so that drove up some of the commodity prices, right? But as you saw that big jump in the dollar in the month of March, you saw that, again, oil had a big spike. Had been coming down, right? But had a big spike on the outbreak of the war. And again, as those supplies are disrupted, oil and energy is one of those things that obviously has an impact to every part of the value chain, right? So as you have more, logistics and transportation expense, that can work its way through to higher prices. We've seen oil prices at these levels in 2022 when the Russia-Ukraine war started, and then again, as I think trading normalized, you saw that the price of oil come down significantly, from into the second half of 2022 and into 2023. But as you look at commodities and gold, again, you had a big run up, in the early part of the year, and then again, just on concerns of the war with Iran and essentially economic concerns, you kind of had a sell off. But a lot of that was just driven by, again, as you look at some of those, driven by the Iran war, driven by the reversal in the trends of the U.S. dollar and interest rates as well. And again, that just takes, money out of the system essentially, right? If you have paper losses in, crypto and commodities and other areas, the part that you might be looking to protect is and ultimately exiting would be, equities and bonds as well. So that creates a little bit of risk. What are your thoughts on that, Jared?
So, David, as you turn now to, let's say, the Fed, the Fed having tightened and pulled it back on the balance sheet over the last number of years, if we do hit a prolonged slowdown or if the war does drag on longer than expected, the Federal Reserve has a lot of options available, right? They could lower interest rates some more, and the big one's the balance sheet. So if you look at the balance sheet, during COVID, they printed a lot of money to backstop the system and provide a lot of liquidity. Benefit of hindsight, we probably had a lot of inflation in 21 and 22 because of that huge increase of printing, 4+ trillion. But over the last couple of years, they've reduced the balance sheet by over 2 trillion. So that gives a lot of flexibility, both to potentially lower interest rates if the economy's slow, help the housing market, and then potentially expand the balance sheet at some point. So again, I think the good news from the market perspective, the Federal Reserve does have a lot available right now if we do hit a prolonged slowdown or, like I said, a longer adjustment within the markets. And again, as you look to the opportunities, an interesting article a month or two ago talking about the revenge of boring, in 2026. And what I was talking about are companies with good valuations, good dividends. You talked about equity income, David, kind of still positive for the year overall. So I think as investors look for areas of the market, valuation is going to continue to matter. I think staying diversified in times like this, and again, with interest rates elevated, I think it's an interesting opportunity to lock in some higher yields, to protect and lock in income for longer. So I think despite kind of the worst month in a while and the overhang of the war, there's still a lot of good reason to be interested and opportunistic within the market. And having said that, we definitely have been a little cautious, have a little more liquidity, and reduce areas of the portfolio like international that just haven't done as well. And the trends, changed pretty quickly in March and staying on top of that. So I think as we look to earnings season and beyond, we'll see what companies say and adjust to the, after the first quarter and looking toward the rest of the year and potentially make some adjustments. But like I said, I think the Federal Reserve has a lot available right now, and we'll see where things move from there. So with that, I want to thank you for tuning in, and we'll touch base next month.
Thank you.